The most dangerous trap for a new investor is looking at a stock's share price to decide if it's cheap or expensive. In isolation, the raw price tag is mathematically useless. It is easy to look at a stock trading at $10 and assume you found a bargain, while looking at a stock trading at $1,000 and writing it off as overpriced. But looking at this animated pie diagram shows why that logic fails. A share price is just one arbitrary slice of a pie. Knowing the cost of one slice tells you absolutely nothing about the size of the entire bakery or what ingredients are inside. Buying cheap slivers of a tiny, failing business will drain your portfolio. Meanwhile, paying a high price for a slice of a company with massive scale and high-quality ingredients is often a better use of your capital. To bridge the gap between price and actual value, we rely on fundamental analysis. This approach strips away the daily emotional mood swings of the market. By ignoring the ticker price and looking directly at the cold, hard accounting of the underlying business, you can compare a global tech conglomerate side by side with a regional bank on a level playing field. You don't need a finance degree to do this. You only need a 4-number cheat sheet, 4 specific ratios that will tell you exactly what kind of business you are actually buying. Applying these 4 metrics takes the guesswork out of investing. They force you to look at the data to determine whether a steep price tag is a ripoff or simply the required cost of entry for a highly resilient business. This quadrant chart maps our entire cheat sheet. The horizontal axis represents our first metric, the price to earnings, or PE ratio. It calculates exactly how many dollars you have to pay upfront to buy one single dollar of a company's annual profit. If a stock has a low PE, say under 10, you are getting a discount on those earnings. But that discount exists for a reason. Often, it's a value trap. The market is pricing it cheaply because the core business model is slowly dying. Conversely, a high PE means you are paying a massive premium. The market expects rapid future growth from the company. But if they miss their earnings targets by even a fraction, the stock will drop severely. Fast-growing tech stocks almost always carry high PE ratios, which makes them look artificially expensive to a traditional investor. To solve this, we add a second metric popularized by Peter Lynch. Metric 2 is the PEG ratio. This takes the standard PE ratio and divides it by the company's expected earnings growth rate over the next 5 years. It gives growth context to a high price tag. If a company has a high PE of 30, but its profits are growing by 30% a year, the math equals a PEG ratio of exactly 1.0. That 1.0 target means the expensive stock is actually fairly priced for the speed at which it's growing. But PE and PEG only tell you the cost of entry. They tell you what you are paying, but they leave you entirely blind to the quality of the business you are getting in return. Moving to the vertical axis of our chart, we measure business quality. Metric 3 is ROE, or return on equity. This calculates exactly how much profit the executive team squeezes out of the money shareholders give them. A company that consistently maintains an ROE above 15% over multiple years is highly efficient. It means they know how to compound money without wasting it, giving them a distinct competitive advantage, an economic moat. But here is the trade-off. Highly efficient, mature companies are well known to the market. Finding one with a high ROE usually forces you to accept those higher PE entry prices to acquire them. Metric 4 is the debt-to-equity ratio. It compares how much the company owes to banks and bondholders versus how much it actually owns. It reveals how the business is funding its operations. The math here is a strict threshold. If the ratio is over 1.0, the company has more debt than equity. When interest rates rise or the economy stalls, high-debt companies face the highest risk of bankruptcy. Prioritizing companies with more equity than debt helps protect a portfolio during a recession, though it may mean missing out on the hyper-growth that comes from leveraging borrowed money. When you find a business that combines a massive ROE with a very low debt ratio, you found a fortress. And that fortress structure is precisely why the market demands a premium price to own a piece of it. Let's pull the live data and apply this 4-number system directly to one of the largest companies in the world, Apple. Right now on our quadrant chart, Apple has a PE ratio of roughly 35.5. That is tracking significantly above its 10-year historical average. From a strict price tag perspective, you are paying a massive premium. When we check the PEG ratio, it sits at 2.46. Because that is well over our 1.0 target, it means Apple fails the value test. It is technically overvalued based solely on its future growth speed. Because the company is already so large, it is harder for them to double their earnings quickly. So if the math says it's expensive, why are institutional investors perfectly happy to keep paying this extreme premium? Because we have to calculate the outcome. Apple's ROE is an astronomical 147.9%. For every dollar of equity, they generate massive returns. This ROE reflects extreme management efficiency. It shows that Apple knows how to compound capital far more effectively than almost any other business, which creates the economic moat investors are willing to pay for. Then we check the survival shield. Apple's debt-to-equity ratio is sitting at 0.78. Because that number is safely below 1.0, they hold more equity than debt. They are heavily shielded against rising interest rates, and they carry near-zero risk of bankruptcy in an economic downturn. The buyers of Apple stock are making a conscious, mathematical choice. They willingly accept overpaying for growth on the front end to guarantee total market dominance and balance sheet safety on the back end. What we learn from Apple applies directly to your own portfolio. These four numbers are not a rigid pass or fail test. They are a system for making calculated trade-offs based on what you actually want your money to do. We can map these metrics on a decision tree to match your specific financial goals and risk tolerance. If your profile is a growth and performance chaser, you are looking for tech disruptors and expansion. You must heavily prioritize the PEG ratio. You will be buying high PE stocks, so you need the math to prove that hypergrowth is actively keeping that PEG ratio anchored near 1.0. If you are a risk-averse capital preserver, your primary goal is not losing the money you've already made. You must treat a debt-to-equity ratio of less than 1.0 as a non-negotiable hard rule. You will filter out leveraged companies and willingly pay higher PE premiums to secure absolute balance sheet safety. And if you are a novice value seeker hunting for a deal, low share prices often hide structural decline. If a stock looks cheap while its ROE is dropping and debt is climbing, you are likely looking at a business in terminal decay rather than a bargain. The financial markets will never offer you a perfect score across all four metrics. In the end, every single investment is a negotiation between the price you pay and the quality you receive. A smart investor does not blindly hunt for a cheap price tag. They calculate the numbers, weigh the options, and hunt for the optimal trade-off between the cost of the stock today and the resilience of the business tomorrow.